Hi, everybody, and welcome to a market update edition with the Martin Eiden team. Here it is at the middle to the end, kind of almost toward the end of July. It's very exciting because we had a nutty first quarter, a nutty second quarter in the other way. The third quarter, the first few weeks, have we reached a bit of a calm or what's going on? So it's an advanced seminar for both buyers and sellers for the next 45 minutes or so. I want to introduce our amazing panelists. So first of all, we have John Pescarella from US Bank. Say hi to the crowd, John.
Hi, everybody.
And then we have Michael Landsman, managing partner of Home and O'Hara, who is an amazing real estate attorney and also a state attorney as well. Michael, thank you so much for joining us.
You're welcome. Great to see everyone.
And then with the Martin Eiden team, we have Alex Mahgoub, who is the team's top salesperson. Hi, Alex. Nice wave there. And then we have Ramzis Hadzhi, who I have nicknamed the Wonder Kid, who's doing an amazing job. Last year did 170 rentals, which is a rental every other day, and is quickly branching out into the sales arena, and it's great. So Ramzis, thank you for your help on this.
Yeah,
so kind of a little bit of a recap right here in the New York market, and this is a Manhattan, Brooklyn market focus. So Q1 2022, if it was for sale and was standing, regardless of condition, it sold, right? And oftentimes there was competitive bids on it. Q2, almost the exact opposite situation with the invasion of Ukraine. Stock market correction and interest rates ticking up 2 to 3 percentage points, depending upon how you looked at it. A lot of people hit the pause button. And then now we're just finding out here for the first kind of three and a half weeks of July, Alex and I are involved in a couple of deals where we're kind of actually finding the calm, where it's almost equal with buyers and sellers. And to be honest, that's my favorite kind of the market, because everybody feels good and feels like they're getting the deal and not getting ripped off. But with that, we're going to first talk with John at US Bank, and then we're going to jump in with Michael Landsman with Home and O'Hara, and then the team will kind of give some feedback. So John, thanks again for joining us. So obviously the big news is high interest rates. And high is all relative, right? In fact, just help somebody get a rate of 4.875 30-year fixed last week, and he could have bought it down to 4.5 in pre-pandemic levels. That was right on track, right? So kind of what's the story and what's the managing expectations, and where does this look in the context of everything?
Well, yeah, the story of the year in terms of the mortgage industry has definitely been interest rates. We saw the Fed completely change its projections at the beginning of this year in terms of what their intentions were, and it's really their projections and their intentions that drive rates. So as the Fed started getting more and more serious about fighting inflation, as the inflation numbers continued to go up, the projections of what they expected to do in terms of raising their Fed funds rate climbed dramatically. At the same time, they started to say that they would be running off their $3 trillion Fannie Freddie bond portfolio. So that had a further impact on the Fannie Freddie rates. And we saw this really wide divergence between jumbo rates and Fannie rates, as much as a point at certain times. Really, we haven't seen that in the past. Generally, Fannie Freddie, what we call conforming rates, which are basically rates for loans up to $647,000, and then jumbo rates, which are loans above that limit for single family residences, were in the same vicinity. If we were talking a year ago, and we were looking at the super low rates that existed then, 3%, even less than 3%, which was a sort of an interesting moment in time. Jumbo and conforming wouldn't have had such a spread, but now there's a big spread. So we're having to approach things differently. One of the approaches that we're trying to do is we're avoiding Fannie when we can. I'll give you an example. At US Bank, we have a policy that allows us to keep a loan on our books and make it a portfolio, which is the equivalent of the jumbo loan, if that loan is going to be an adjustable rate. So I'll give you an example. Let's say we're looking at something. I mean, rates are down, which is nice. We've gone from close to 6 now to basically close to 5, right? In a very short amount of time. But let's say you're looking at Fannie Mae at 5%. If we can do something like a 10-year ARM, we're going to be at something like 4.5%. So I've been using that a lot this year, and essentially it's not a Fannie Mae product; it's an in-house product, and we use that to keep the interest rate lower, keep the payment lower. It's been a very effective tool this year. You know, there are some misperceptions out there about adjustable rates. I mean, the first thing to understand about adjustable rates is that there is a long fixed period. They can be fixed for as long as 10 years. So if you looked at that, let's say a 10-year ARM and a 30-year fixed, if you looked at the amortization tables side by side, they would look identical if the rate were the same. So there's no difference until that, let's say that 10th year or when that fixed period ends. Some folks won't have the loan in 10 years. They might have sold the property, they might have paid it down. ARMs allow you to refinance them at any time, and you can refinance them into a fixed product if you want, or into another ARM. So they're really good tools. It's just one of the ways. You had mentioned before someone looking at a buy down, paying discount points. That's another thing that's become popular again, is to consider paying some points. I do think that even though the short-term picture is still clouded, the long-term picture is very likely that rates are going to be, in my opinion, that these rates that we're seeing are going to be refinanced over the next several years, especially over a 10-year horizon.
That makes sense. And then, you know, again, since this is an advanced seminar, if you will, it's funny, I talked with someone who's actually on their fourth purchase. They had the first time buyer, the family home, number one, the bigger family home, and now they're empty nesters and buying a place that's almost twice the size as the anyhow. But he talked about that his first property was 30-year fixed. And he's like, I'm never doing a 30-year fixed again. I'm never going to be in a property for 30 years. That makes no sense. And he's been using the 10-1, which is great because it is fixed for 10 years. The odds of you being in the property for, if that's your plan, 10 years or less, most New Yorkers move on to something else. And then if you get paid in chunks, either through stock options or RSUs or bonuses, you can pay down the principal that way as well, which is, I always thought was kind of nice on that. And then just kind of in context, I have two questions for you, John. So now we're expecting the Fed to increase the overnight rate by 0.75 points, maybe even 1 point, I believe, on tomorrow or Thursday, right? Can you just give us a quick, like 30 second to 1 minute explanation of how they are not related or directly related to mortgage rates? Because some people get confused on that.
Yeah, that's a great question. I do. So for example, the Fed decision will be tomorrow. So there will be a Fed announcement tomorrow afternoon. They will say, well, we have raised, and everyone's expecting 0.75% to the Fed funds rate. I'll occasionally get a borrower who a day before an expected move, they'll say, I want to lock today before rates go up. But what the Fed is projected to do tomorrow is already completely baked into mortgage rates. Mortgage rates are primarily based off of longer term bonds like the 10-year treasury yield. And so what the Fed is doing with the short-term rate has no direct impact. What has a direct impact is the Fed expectation. The reason that we've actually seen rates come down in the last several weeks is because there is an expectation that by first quarter of next year, the Fed will actually start lowering rates again. So it's all about that what they call the terminal rate. Where do they think the Fed is ultimately going to get to, and at what point are they going to start dropping again? And the market moves lightning fast. So when that sentiment comes that says, okay, we might have a recession, the Fed might start moving rates down. Really, it's the what I call the long money. It's the people who are investing in those longer term bonds that are really driving where mortgage rates go. It's not what the Fed is doing tomorrow or even 2 months from now.
Okay, that makes sense. And then kind of the other quick question that I have for you is the rates now, is it correct to say it's comparable to what the rates were pre-pandemic? And if you will, rates were on sale for that 18 to 24 month period because everybody didn't quite know what was going to happen, or how would you phrase it?
I would say that since the financial crisis, we've been in a pretty abnormal rate environment.
Okay. And you're referring back to the 2008, 2010, correct?
Exactly.
Correct.
I can very vividly remember December 2008. So this is 3 months after Lehman crashed. And I can remember for the first time the 30-year fix getting pushed under 5%, 4.875. And we were all marveling at it. But that it was a very long recession, it was a very slow recovery. If you look at the inflation numbers, there was basically no inflation for a decade. There was also a very sluggish growth. So during that time, the Fed actually kept their rate at zero for about 6 years. It wasn't until 2015 that they started moving things up again. And you saw mortgage rates, 30-year fixed rates, basically in the fours. In the threes occasionally. There was a brief period where the Fed tried to raise rates in 17 and 18. But in 2019, they were, and I would say at the end of that cycle, the 30-year fix got to about 4.5. So not too far off from where we are now. So I would say, yes, to your question, I would say it's comparable now to pre-pandemic. Right before the pandemic. But if you look back further, that 8-year period, let's call it 2010 to 2018, or call it 2009 to 2016, 17, rates were I would say abnormally low. And whether we're going to go back to that, we'll have to see. We have to see if after inflation goes away, are we going to have strong growth? We're going to have a tight labor market, or is the Fed going to have to get back to stimulating again?
Okay. Well, thank you, John. I really appreciate the full context on it. This was definitely an advanced conversation. Now I want to switch over to Michael Landsman. And Michael, we've known each other for what, almost 18, 20 years now.
Yeah, a long time.
Grown up in the business together, if you will. So kind of it's always fun to see how it fluctuates back and forth, right? When it's a seller's market, buyers have to waive all kinds of contingencies, and then when it's and Michael and I had a couple of deals that were in contract in the height of the pandemic, and we had to adjust prices and give money back for the sellers to actually close. Where are we right now, and what's going on, and is everybody happy or unhappy?
Well, I tell you, first of all, the happiness question. I wish if I could answer that one, it would be helpful for everyone. But first of all, I want to thank you, Martin, for inviting me to speak this afternoon with you guys and talk a little bit about the market. And as I see, you and I have been in the business for a long time. There's 9/11, there's 2008, and then there's COVID. And after 9/11, I remember that was when I was learning how to negotiate out of deals, because we had clients that were walking away from 10% deposits because the market dropped 25% overnight, right? Which was sort of scary. And then 2008 is sort of a similar thing. Now, maybe not quite as severe because we could sort of see what was going to happen. It wasn't as abrupt. Obviously, no one was predicting 9/11, right? It was not.
Right.
At least no one outside the intelligence agencies, right? They weren't telling us about it if they were predicting it. And then you had COVID, which interestingly enough, obviously started in, well, wherever it started, but in Europe, it became a problem before it became a problem here. And then we all watched like a, kind of like a small, like a car accident sort of. Right? And then all of a sudden, boom, the city got shut down. And again, we had that same kind of post 9/11 situation where, to your point, we were negotiating, obviously as sellers, we were really trying to hold, and I think we held those deals together really well.
Yep.
Retrospect, in retrospect, I'm proud of how effective we were able to hold them together. And now we're still dealing, obviously, with COVID, right? And it's a lot different than it was in March of 2020. But that is still a factor. The monkey pox isn't quite a factor yet. Hopefully, it won't be. But as John was saying, the interest rates have also been kind of the star player. So now we're in this kind of post-COVID, maybe COVID. We're in the variant recovery now, right? and to your point, what we're seeing is people who we're not seeing as many foreign buyers show up right now as we were.
That is true.
And I think the data bears that out, right? In terms of that, because they came back with a vengeance as soon as the airports opened up again, and they were buying apartments like, hamburgers. It was actually a lot of fun there for about 6 months. But now we're seeing New Yorkers who are trading one asset for another, and they're trading in the same market, right? So you've got people that maybe they're like, the kids are going off to college in September, and they're testing the market to both buy and sell. And that's where a team like your team and obviously our law firm work really, really well together, because we help these clients transition between these two deals. And that's actually very helpful for the clients to have a team come in and sort of pre-diligence what they're going to be offering on, in some cases, making sure that it's going to go by. It's going to, the diligence is going to pass muster, maybe even get the lender involved, right? To John's point, and that's a great point, after that Sunnyside disaster, that collapse, they're asking insurance companies and banks, attorneys are asking questions they've never asked in 20 plus years. So we have to just be careful and mindful of that. And then of course, we're trying to time the deals so the clients close. And if they're not in the camp where they can just spend a couple of months in the country, which not everyone has, 2 places they own. We help them navigate that. So that's really kind of what we're seeing now. We're seeing New Yorkers who have been in the market for a long time, who are now looking to change due to personal circumstances. Either the kids are growing up, or they're having kids, or whatever. That there's a life change that is market. What would you say? You would say irrelevant, right? It's irrelevant. Right. It's irrelevant to them whether they're hearing the buzz that it's a good market or a bad market. It's the market, and they're going to navigate the market, and they're going to have a team like your team and my team help them successfully navigate the market and pull off these 2 transactions. You certainly don't want to buy and sell in different markets. You want to try and do it in the same market if you can. And we've heard that, mantra from the financial people. They want to trade in the same market. And ultimately, and just with those 3 most recent market events, I'd call them 3 earthquakes, right? The 9/11 earthquake, the 2008 earthquake, and the COVID earthquake. We've weathered, and certainly the real estate market in New York City has weathered those storms pretty well. And ultimately, at each point after one of those events, the market's gone back up again. So
right.
So that's really kind of what we're seeing. And you guys can speak to the market, better than I can. But from a law firm perspective, that's what we're seeing. We're not seeing a flood of deals, but we are seeing deals come in, and deals are getting done. Sometimes you have to pull a few extra teeth, but
right.
But look, and from my perspective, and by the way, a shameless plug here. My book just came out a couple of weeks.
Oh, that's awesome,
I
Michael. I
have to do
I'm
that.
expecting a signed copy. You've been working on that book for 2 years.
Yeah. I've been working on this book. This is my COVID project, but with all seriousness, in my book, I talk about this. The interest rates are still ridiculously low. I think people got tricked somehow into thinking that if the rates go above 2.5% or 3.5% or 4%, it's too expensive, and that's not the reality. The reality is the mortgage rates in the New York, and certainly in the United States, are incredibly low, and they've been incredibly low for years. I mean, there isn't another country that gives you the opportunity to borrow money at a fixed rate for either 10 years or 30 years. They don't even have 30-year mortgages in the UK. The product doesn't exist because the banks aren't willing to take that risk. So when they need some upside, and 30 years is a long way to wait for an upside for a loan. So I'm pretty bullish on borrowing money at anything below 7%. Really, people are going to think I'm crazy, but my first mortgage 20 years ago was about 7%, and then I refinanced it, over time, and now I've paid it down quite a bit, but I haven't refinanced. I didn't refinance it at the absolute bottom just because 3.75 for a jumbo is still a gift from the gods. I mean, people don't.
Right.
No, it is really. I mean,
no, it is. It's very true. So just
perspective, right? So go ahead.
No, go ahead. So next, I wanted to, come back to both you, Michael and John, in just a few minutes on kind of this stuff. So Ramzis, kind of give us a little, the hot story, and it's always kind of funny. If sales are up, traditionally rentals are low, and then vice versa. For a while, both sales and rentals were up. Ramzis, what's going on now with the market, and what's your suggestions for people that maybe is this a good time to buy?
Yeah, Martin, like you said before, last year I did 170 deals, which is like a lot of rentals for 1 year. And I decided to jump into the sales with your team. And I think that was the best thing that I could have done. So like interesting, like the rents are so high right now. We get that market report from the rents that the average rent in Manhattan is $5,000. I mean, $5,000, like Michael said, and John, the interest rates before, they were like very high. Now they're like in the 4s or 5s. That's still very low in overall. And during the pandemic, we had such a low rents, but also we had the low interest rates, which was unheard of. Now, a year or two later, we have the rents, which they are 100% up and more. And I really think like people who is paying $5,000 a month for a 1-bedroom in Manhattan, they should really look at buying. I mean, you will be paying less on your condo, which you will get much better space, quality. And at the end of the day, you are paying towards your investment versus the rent when the rent just goes down the drain and it's wasted money.
Yeah, no, I agree. And I think you made a really good point there, Ramzis, that usually, when you buy something, the quality of the finishes in something that you buy versus renting is vastly different. Did you want to touch base on that a little bit?
Yeah, I mean, look, when you buy an apartment, usually it's from an owner that takes care of them because it's their space. Now, when it's a renter, not necessarily everybody takes care of the property. So now you're going to rent apartments that they, landlords, some of them, they have great quality. Some of them, it's just like it's tenant over tenant and it just gets wear down. When you own, you take care of the apartment more. So the quality, it's better in overall.
That's great, Ramzis. Thank you. And then one other quick thing, Ramzis, I just wanted to ask you before I jump into Alex. So Ramzis is actually working with a couple of developers right now, and one of Ramzis' skills is floor plans. And I'm shocked to see how small those rental floor plans are. The bedrooms, barely fit a bed, and people are throwing application after application in on it. Maybe touch base on how that versus a spacious something that you buy.
Yeah, for example, like 2-bedroom right now that I have downtown, it's like about 500 square feet, 2-bedroom, 2-bathroom, and the rent is $7,000. I mean, when you buy a 2-bedroom, at least like 1,000 square feet, and
Yeah.
maybe you will pay like 7, 8, depending on maintenance, taxes, but you get double the space for the same amount of money.
Right. No, it's absolutely true. Then and that's just the formula that developers do. If it's a rental building, is how efficient can they use the space?
Yeah, I mean,
Thanks, Ramzis.
yeah, of
Go
course.
ahead.
Thank you. No.
All right. And now to you, Alex Mahgoub, state of the market, man of the street. It's funny, we have our team Zoom meetings every Monday, and without fail, Alex is always on the sidewalk, always walking around, sometimes in his short sleeve shirt showing off his massive biceps. But Alex, give us the rundown of what's happening here.
Beautiful. Thanks for that introduction, Martin. I'm embarrassed and flattered at the same time. So this is an advanced buyer seminar and selfless or shameless self-promotion, but not for me, but for these two men on this call. John Pasquarello is an amazing mortgage lender. We're currently working on a deal. We've done a bunch of deals recently, and he's been so super helpful. And Michael Landsman, we recently did a deal together that was a little messy, and it was really amazing to have you in our corner because you made a huge difference. So, if you take one thing away from this call is who you work with matters. Work with the best, work with people that you like, know, and trust. But let's get to the matter at hand, talking about the market. So, everyone asks a realtor, how's the market? How's the market? How's the market? Me, I always say it's amazing. Why? Because I love what I do. I love helping people and making a difference in people's lives. And this market over the past 2 years has been insane. The experiences I've had as a realtor have been overwhelming, exhausting, and exciting because I made a lot of money too. So let's backtrack a little bit and talk about this market, talk about Manhattan and Brooklyn for sure. But going back, 2015, 2016, 2017, essentially represented a toppy time in the market. People were buying apartments based off of a floor plan. Pricing was through the roof. It was a crazy time. And then things started cooling off. We had a correction, 2018, 2019. Prices were coming down. There was less deal volume. And people might say, why? Why did that happen? It was essentially caused by policy changes. They capped SALT deduction, state and local taxes. China stopped people from bringing boatloads of money and buying property. There was rental regulations. And again, things that go up must come down. So the market cooled off a little bit, 2018, 2019. And then the very beginning of 2020, things started turning. We were excited for a brand new market and a new season. And then what happened? Pandemic. And literally the city shut down for 3 months. During that time, I never thought I would sell another home. And then when things opened up again, June 22nd, it was scary. It was end of days. I would walk the streets alone, me and a lot of hungry pigeons because no one was feeding them. During that time, I don't know if you guys remember, we were only able to do one-on-one showings, because of virus. You had to mask and wear gloves and hand sanitize and keep 6 feet away. So during that time, I probably did from June 22nd to the end of December, I probably did 1,000 showings. 1,000 showings one-on-one with a buyer in a property from the Upper West Side to Fort Greene, Brooklyn, co-ops, condos, townhouses. And I would look people in the eyes and say, what do you think? And they'd say, are you crazy? Buy an apartment in New York City? But that was the time to buy. All right. Warren Buffett has a great quote, Be fearful when others are greedy, and be greedy when others are fearful. The time to buy is when people are nervous and scared. And people that bought during pandemic got some really great deals. But what happened in late 2020, we had the most contentious election of our lifetime. Our world was in utter chaos. There was no vaccine yet. It really seemed like end of days. But then there was a vaccine, came through, and we got a new president. And beginning January 2021, there was all this pent-up demand. People that saw that New York was on sale, and they came running. Some people that used to live here 10, 20 years ago, people from Portland and Seattle and California, they saw that New York City was on sale. And when something's on sale, you buy it. So last year was, I think for most realtors, the best year they've ever had. And frankly, because of that, I was able to buy my own apartment that I'm in right now. And being a homeowner, beyond saving money, Ramzis said that the average one-bedroom rent is $5,000 a month. That means each year you're just basically throwing away $60,000 when you can buy something, build equity, have it increase in value, own that asset, and then sell it for more money. And now as a homeowner myself, I can tell you that being a homeowner is fun. It's exciting. It makes you feel great to come home to, in a home that you love, that you chose, that you selected. So basically the past 18 months have been gangbusters, crazy, frenetic, nutty pace, exhausting. And recently things have been slowing down. Martin touched upon this. Why? Why are things slowing down? Why now? Well, things can't go at a frenetic pace forever. That's part of it. But interest rates started to increase. When interest rates go up 1%, it affects the buyer's ability to purchase by about 10%. So if interest rates have gone from 3 to 6, for some buyers, that's impacted their buying power by 20, 30%. So that's pretty significant. And then beyond that, we have a global war happening, the war in Ukraine and Russia. That gives people fear and anxiety. Inflation, everything costs more. Is now the right time to buy an apartment? I'm not sure. And then the stock market volatility. New York City is a city that is tied to the financial market. When people, lose money in the stock market, even if they're just paper losses, it gives them pause. But I can't stress to everyone that's listening on this call that the next 3 to 6 months will be an amazing opportunity where new listings are going to come to market, where old listings that have sat on the market for 2, 3, 4, 6 months, whatever it is, you're going to have exhausted sellers who are willing to negotiate. This is what every buyer in New York City wants: a deal, negotiability, to be able to go and see an apartment and it's not gone in 1 week, to submit a bid and you are the only bidder. There's not 5 or 7 bids above the asking after one open house. So this is the opportunity. This is the time. This is when you take out the money and you buy.
That's great, Alex. I think that makes sense. And kind of touching base with Michael and John on it. You said you wanted to talk about some anecdotal things, and I also just wanted to talk about people with the real estate ladder, buying and selling, and what experience you had with that, or the anecdotal part, or what else did you want to share?
Me or John?
I was gonna go for Alex first, and then I'll go to you guys. Sorry,
Oh, yeah,
sorry, it wasn't clear.
What was the question? I'm sorry.
Oh. All right, let me rephrase, and then I'm gonna take a technical thing. Jared, I heard recording stopped. Are we still recording?
I think he was popped off the call.
Okay, so just hold on 1 second, guys. Let me, because if he popped off and he was the host, we may have stopped.
Oh, zooming.
Yeah, hold on.
I know we're still on Facebook Live for.
Oh, okay.
Out there.
Technical difficulties here. We'll see what's going on. This is very exciting. All right. Well, you know what? Let's just continue to go then. And we'll take it from there.
You got.
All right. Exciting live action. All right. So
Martin.
Yes.
Do you want to just press the record button so we can?
Yeah, I can do it. I'll do it right
Yeah.
now. All right. High tech excitement. Where's the? Where's the record button?
Next to the share screen on the bottom.
Oh. It's on the top here. So let me see. Any rate, let's just go with it, guys.
All right.
Sorry about that technical aspect of it. We're still live, so that's all that matters. All right. All right, Jared's back. All right, we're all back.
All right.
You
Sorry
missed
about that.
Alex's amazing thing, but we're recorded. We're back. All right, so let me
Okay, good.
reframe it. Everybody, thank you for that technical difficulty here. So the question that I have, it's to you, Michael, right? We're talking, and then just as a quick summary, right? Kind of this is an advanced buyer seller seminar. Most New Yorkers have a real estate ladder of 4 steps. Your entry level home, right? Which for some people, honestly, is a $2 or $3 million apartment. For others, it's a $500,000 studio. It doesn't matter where you start, entry level, and then you have the upgrade, which would be a 2 or 3 bedroom. And then for a lot of people who choose to have families, they want to get the big 2,000 square foot plus home for the family. And then the fourth one is what I call empty nester phase, which pre-pandemic usually meant downsizing, but recently we've had people not only increase in size but in price because they want to make it their palatial pad, if you will. So Michael, the question that I have for you, and then I'm going to go to you, John. You mentioned a little bit, like, what is it best to talk with an attorney before you start doing this, and what are some of the questions or things that someone that's doing the buy sell, what should they be thinking about?
Well, look, many of our clients do call us, so I do think it's a good idea, especially if you have a relationship with a client. I mean, a lot of our clients here at the firm are repeat clients, right? We've represented through all these phases. In fact, now we're representing their kids starting these. And the questions usually start to come to us when they're actually serious about making an offer, because they want to look at closing costs, and that can be a big factor. And as you know from the recent sponsor deals, it used to be that the sponsors were foisting all the transfer taxes on the purchasers, and now a lot of that stuff can be negotiable, right? Because they're willing to negotiate. So they want to drill down a little bit on the closing cost, and they also want to drill down a little bit on the diligence to see if there is going to be any issues. They have a friend who's heard about the building, and what do they know? Is there going to be a lot line window? Those sort of technical questions, because they don't want to spin a lot of wheels
Right.
unless they know and they have a reasonably high confidence that the building is going to diligence well, and that we're not going to find anything that would sort of disrupt that, which is rare, frankly. I mean, if you do take a look, and the tools that we have now available with the online libraries for offering plans, and we've done deals, and we've done thousands of deals now. So chances are somebody's done a deal in a building, and we know who the managing agent is and so forth. Then that's really the first calls we get, is what they're looking at. And then the same thing is, well, this is what we're selling. Give us the cost on that. And is there a flip tax? Drill down on those.
Got it.
Some potentially big ticket items. And this happens with our tenants that are buying. Sometimes a tenant will buy from the landlord they're renting from, right? So that can happen too. Was there a flip tax imposed in the building? And for those people that might not be familiar with that, it's not really a tax, it's a transfer fee. They call it a flip tax, but if a building has changed the policies, they want us to verify that. And that's a few phone calls, and sure, there's a flip tax, or there isn't a flip tax, or good news, the purchaser pays the flip tax or the seller pays the flip tax. So those are the types of deals, that we get involved in pretty regularly. So we're managing the financial expectations in the sense of the closing costs, and then helping them with structuring. Some people want some kind of timeline. We're going to
That
make
was what my follow-up
right?
was, how
Yeah.
do you buy and sell? And am I
Yeah,
going to be
exactly.
homeless for 6 months, or how
Right.
does that work?
Exactly. And in a market like this, which I think you said earlier, that it's sort of a kind of almost a happy time, if you can call it that,
Right.
right? In other words, sellers are sort of feeling good about their offers, and purchasers are feeling good because they're not getting, they're not in a desperate frenzy for properties. Then we can work out, hopefully, something like a post-closing possession or holdover. I represented a commercial real estate broker last year, and we were able to negotiate some good post-possession agreements for his current apartment that would bridge him into the new apartment.
Oh,
And
great.
that, and from doing this yourself, that can be really helpful for sellers who are looking to buy and don't want to, to your early point, liquidate any equities, for example, in a market that's down 15%, right? Because that's going to,
Yeah.
that $1 million they're trying to raise is actually costing them, 15% more, or whatever, on average. So we're really kind of, coaching, right? We're sort of helping coach, and really it's a confidence game, right? The legal game is a confidence game. It's giving people the confidence that we've been doing this a long time. We can help you with this, no matter what it is. We've seen it, and generally that's true. So that's really when we get involved, and we give people the confidence to call us whenever they have any questions, and we work on the weekends and all of that jazz, because the market never sleeps, and that, Mark. We've had a lot of
Right.
calls over the weekends. The market never really sleeps. It's kind of funny because stockbrokers have a difficult job, because absolutely every asset is for sale at all times during the market hours, right? Because
Right.
you could buy stock in Google, but you can't buy apartment 2F at 530 First Avenue every minute of every open market day. So it is a different type of market, but it's a market nevertheless. And a lot of stuff does come up on the weekends, as Alex will tell you. When he's done at the gym, he's out showing apartments, and their clients got a call about a deal point, a legal point. So that, I hope that was helpful.
Yeah, no, that was very helpful, Michael. Thank you. And now, so John, tell us a little bit about someone who's doing the buy sell transition. They go to you and say, and again, as people climb up the real estate ladder, traditionally their income substantially is increased as well. So something they bought 5 or 6 years ago, their income could have doubled, tripled, or even tenfold, with a lot of stuff going on. So how do you have that conversation, and how can you help people with the buy sell like that, John?
Well, that's that situation comes up a lot. I love what Michael just said. I think that solution he's providing, a post possession agreement, that's really clever, and I think that's why it speaks to why it's really important to work with the right professionals who can figure out what is your particular need. So that solve he has is for that person who's got that equity locked up. And so he's going to use that post possession, allow them to sell and take that equity and use it in the new purchase. Because as we know, doing back-to-back transactions, selling and buying, I have done it when both properties are a house or a condo. I have done it in the city. It's not impossible, but it's difficult. There's another buy sell situation which arises where someone has the assets, but they don't qualify to carry 2 properties. So it's important really, as you're going through the process, really, this is why it's important to speak to a lender to really understand what the specific needs that you have are, because not everyone's the same. Some people have the assets for the down payment on the new place. They don't need to pull that equity out, but they're not going to qualify to carry both properties. The bank's going to
Okay.
too much debt. There are ways around that. So, for example, getting that current residence into contract and satisfying contingencies, that now releases that from our debt to income calculation, and we can go ahead and close on that new property. So we have solutions around that. I think it's really important to just get clear on everything. People, they always say, well, get pre-approved. I think getting pre-approved is important. It doesn't go far enough though, because I think a lot of lenders look at the pre-approval process and they just sort of, they don't tell the client what they don't know. In other words, you can pre-approve someone by just saying, hey, just let's put in your income, your job, your assets, pull your credit. We do an automated review of that. A computer spits out the pre-approval letter, and people think that that's the whole process, but there's really so much more involved. Something I'm using now are fully underwritten pre-approvals, where we actually get all of their documents, we send them to an underwriter, and we get a full approval. So now everything's been vetted. If you end up needing to move quickly, or if you end up in a situation where it's going non-contingent for whatever reason, you're ready to do that. Likewise, getting.
I just wanted to reiterate that point. Fully underwritten pre-approval. So traditionally for pre-approval, somebody gives you your tax returns, you check the credit to verify their income, and that's a pre-approval. But fully underwritten is someone has already submitted, for example, the last 12 rent checks cashed or mortgage payment. You all the paperwork has been submitted. Is that?
Exactly. All the paperwork, everything's been looked at. For example, let's say that there were a lot of people in forbearances during COVID. Those actually can prevent credit challenges. We have to verify that they've been back on time with their mortgage payments for a year. Verifying on-time rent payments. When you're doing a pre-approval and you're just pulling credit, you're not seeing 12 months of rent payments. That's not on a credit report. Until you get those payments, then you see, oh, there's a 3-month period here where you didn't pay rent. What's going on? Or when you actually get the bank statements and you see money movements, you see maybe assumptions that the client was making. The client was planning to use business funds. They're planning to use crypto. These are all things that really need to be looked at. Maybe they're planning on selling hard assets, or they're planning on getting money from a source that's just completely unacceptable to the lender. A fully underwritten pre-approval is going to vet for all of those issues. Now an actual underwriter. It's basically the equivalent of getting a commitment letter without the property address. So it gives you a lot more confidence as you're both for the agent and for the client that this is real. The financing that's behind me is real. At that point, the only thing we have to look at is collateral. And Michael made some good points about collateral as well. We jump right on that as soon as possible. I encourage people, we try to review collateral beforehand, meaning the building, right? So as soon as the accepted offer is out there, we're trying to find out as much as we can. While Michael's doing his due diligence, we're doing our due diligence to determine, are there any factors? One of the things that really changed with Surfside is that every building that was pre-approved, that was approved with a lender. So a lender has a list, a huge database, all their approved buildings. Documents expire on those, so they have to be refreshed. But once the Surfside thing happened and the new guidance came out that lenders had to verify whether there were any structural issues or deferred maintenance that the building had been avoiding, essentially every building went back into unapproved status. So you can't really make the assumption that a building is going to automatically, if a lender hasn't looked at a particular building in the last, let's say, 8 to 12 months, they're going to be asking new questions. I actually brought a few of those questions because I think they're interesting. And these are specific lender questions that are out there. Is the board?
Okay, yeah, give us some insight.
I'll give you a few. So is the board aware of any current failed local, county, or state inspections So maybe they failed some inspections. These are new questions. This wasn't being asked previously on condo and co-op questionnaires. Are there any regularly scheduled maintenance or repairs that have been delayed or deferred? If yes, provide a detailed explanation. Does the board have any knowledge of any adverse environmental factors affecting the project as a whole or any individual units? So they're asking these questions and they're looking to see if the building has pushed off. Now, routine maintenance, not a problem. And routine maintenance is frequently done by assessment in New York City. So we're a different kind of market. The rest of the country, they're usually building capital reserves more aggressively. New York, generally, if there's something coming up that the building knows they have to do, they're going to do an assessment for it. And a lot of non-local lenders don't really understand that. So you can run into trouble with the local lender when they're not really understanding how these new rules, these new lending rules about deferred maintenance apply to New York City because we operate a little bit differently here. But yeah, I think it's really important to understand and just have all your numbers straight. Understand the product availability. You know, we have at US Bank, we have a 90% financing, no mortgage insurance product. It's a fantastic product. You can borrow up to $1 million with just 10% down, and there's no mortgage insurance. So not only are you getting a better rate than the Fannie Mae rate, but you're avoiding the mortgage insurance that would go along with that rate. You know, there's a lot out there. We do construction loans. Maybe you're buying something that needs to be fixed up a little bit, and you'd like to finance some of that renovation. We have a product for that. So it's a lot more than pre-approval. It's really understanding how your transaction is going to look. Where are you getting your assets? You know, as Michael said, are you wanting to sell your equities in a down stock market? Probably not. There are alternatives to this, and it's really important, I think, for buyers to get clear, especially as you said, Martin, in buy-sell situations, because that adds a second level of complexity.
Wow. Thank you very much, John. So yeah, so this is a lot. This is definitely, I've learned a lot on this advanced seminar here. So just a quick closing. We're already at 6:53. There's so much great information. It went a few minutes. Well, initially it was an hour, so I guess we're taking up about that time. So some closing thoughts, Ramzis, do you want to say some closing thoughts on everything that's been going on here?
No, I mean, you know, I learned a lot from Michael and from John. This is, like I said, I joined, you know, in the sales pretty recently. So this is some great information for me.
Oh, great. Thank you, Ramzis.
Yeah.
And Alex, what would you like to close out with?
Just a couple of quick thoughts. You know, I remember during pandemic, during that June to December time, that was really scary and prices were down and there were great opportunities. And a lot of buyers I met, they said something like, oh, I'll buy next year when it's 10% lower. It never went 10% lower. It is impossible. It is impossible to time a market. You don't know when the bottom is in. You don't know when the top is in. You buy because you need it. You buy because you want it. You buy because you can afford it. And we're back to a more normalized market that has seasonality. So if you're in the marketplace right now and you're looking and there's like nothing on the market, it's because July and August are slow. People go away on vacations. People don't want their property shown. But I promise you, September, October, November, new properties are going to come to market. And if there's an uptick in pandemic, COVID cases, if monkeypox has, you know, reared its ugly head or whatever, there's going to be amazing opportunities. Be ready, have your team in place, have everything ready to go. And when you identify the property of your dreams, you call me.
Fair enough. Absolutely. John, a quick parting thought from you.
I just want to echo what Alex just said in terms of not trying to time. I think there's a temptation for people to try to time rates as well. And there's really just no way to know. The market moves and adjusts so quickly to information. As I said, the reason mortgage rates have come down is because they've already priced in this expectation that the Fed is going to start decreasing. So don't wait don't wait for Q1 of next year thinking that's when mortgage rates are lower, because all those adjustments, those expectations will already be baked into mortgage rates by then.
That's great. Thank you, John. And last but definitely not least, Michael Lanzman.
Well, I tell you, Martin, I too learned a lot from this. I think Alex had some great comments, and John's insight into the interest rates was really helpful to kind of get a better understanding of that from the lending perspective, and which of course is very important, right? I mean, a lot of people they're borrowing money, not only because they need to, because it's a prudent approach to investing in real estate, right? So, but I definitely agree with the sentiment of it's time to jump in when you're ready to jump in, not because you're going to try and trick the market. It just doesn't work that way, right? And if the interest rates go down dramatically, which they probably won't go dramatically, then you refinance, right? Which is exactly what I did when I first bought my first property. I ended up refinancing it a couple times, and when I bought my second property, and now I've got a third property, and I've got a 10-1 arm that I'm gonna buy another property that you can help me find to rent out in the city, because I think it's a good investment. But yeah, don't try to overthink the timing of the market, because it's just not, look at it this way. It's less expensive to get out of an apartment you don't like than it is a marriage, right? So
all relative. Looking
right?
like a true
I mean,
attorney.
it's just an apartment. It's not going to be for the rest of your life, not till death till you part, just till you don't
Right.
like it anymore.
That's great, Mike.
A lot of our first time buyers, and second time buyers, they get sort of frozen at that decision point, right? Analysis paralysis. And, like the good doctor said, everything's okay, right? So anyway, nice to see you guys. Enjoy the rest of the summer.
All right. Thanks. And thanks everybody for joining us with the Martin Eiden team for our advanced buyer seller seminar. And we'll talk to you guys soon. Thanks.
Having me.
Thanks.
All right.
Thank you.